everyone for joining our Wealth Builder workshop. So we started the monthly workshops instead of the bi-weekly meetups or the weekly meetups. We kind of transitioned. So we're going to do once a month a workshop for you to bring all the knowledge for you guys and then answer all your questions. So today's workshop is on building a real estate empire, tax strategies for generational wealth. And we have Shauna, the tax goddess, with us. And believe me or not, her last name is Tax Goddess. So welcome, Shauna, to the show.
Thank you so much for having me. I'm excited to be here today. Excited to answer some questions and, of course, give a ton of value on how to build an empire. So I'm excited.
Yeah, me too. So a little bit about Shauna. Shauna is top 1% tax strategist in the country. She's the founder of Tax Goddess Business Services and has saved businesses and individuals over 1.6 billion with her innovative tax solutions. With over 20 years of experience, Shauna has featured in top media outlets like Forbes and CNN Money, and she's here to share how you can maximize profit, minimize taxes, and plan for financial success. So before we get started, I would like to go through a small little disclaimer. If you have questions, all questions are welcome, first of all. So use the Q&A box for the questions. We'll address all your questions. And if you miss any, please email me at vinki@loombainvest.com and we'll answer it for you guys. And that's it. We're just going to have fun, right? No more housekeeping items there.
I do think fun, most people don't exactly think tax and think fun, but we do. So I think it'll be great.
I want to make it fun because whenever I'm with you, I just feel like everything is so easy, right?
Aw.
So let's start with the first question with you, Shauna. What is the biggest tax strategies that can help investors save some taxes? And while you're talking about that, or addressing that, I would like you to address the difference between the tax strategies and investment strategies and how they go hand in hand.
Well, and maybe if you don't mind, I think I'll start with that, with a little tiny bit of background here. So
Mhm.
one of the things that most people, when they hear, a tax strategist, one of the very first things that go through people's minds is, wasn't that what my CPA does? No. The answer is no. So just to lay a little tiny bit of groundwork here, according to Google, there are 660,000 CPAs in the US. CPA can do anything. Tax preparation, they could be a controller, a CFO, an investment advisor, right? CPAs do all sorts of things, okay? When you start to look at the pyramid of expertise, specifically in tax strategy, you have, of course, the baseline, right? You've got your CPAs, 660,000. You have masters in taxation. There are only 60,000 of us. Then you start to get into certified tax something. So certified tax coach, certified tax practitioner, certified tax strategist. And so when you look at this pyramid of expertise in tax strategy, the CTS, that final designation, there's only 15 of us in the entire country. And that's how we end up in the top 1% over and over and over again, how we save people all this money because of the differences between tax strategies versus investment strategies, right? Many people will go to their financial advisor, right, to their team and say, okay, want to save some taxes. And the investment advisor will come back with, great, let's invest in oil and gas, solar, tribal credits is a big one that just came up this year. There's a million and one different syndicated conservation easements, which if you hear that term, run away unless it meets some qualifications. We'll talk about that. I have an odd feeling today. But when you look at investment strategies, you have to put money into something to actually save tax dollars. So that's always the way I look at investment strategies. Tax strategies, without the word investment, there's about 1,800 tax strategies that, yes, you may have to move money, right? So it may go from one entity to another entity, or one pocket to another pocket, or pay it to your kids, so it might be moving money, but generally tax strategies keeps the money in some way that you either own or own whatever the final asset is, okay? So I always like to use oil and gas as the primary example. If I invest in oil and gas, let's say I put in $100,000, maybe I get my money back. Maybe, right? Hopefully. I know that I got a great tax deduction, typically 92% in the first year,
Mhm.
but it's still a tax deduction, right? It's not dollar for dollar. I'm not going to get my money back for sure. It's not going to happen. When we talk about tax strategies, and so I'll use real estate because it's one of our main topics today, right? If I buy a piece of property, I've converted cash, liquid cash, into real estate, but I own it, right? So as long as I pay my property taxes, we're good, right? Nobody's going to just take my asset from me. And at some
Mhm.
point down the road, I can sell it, hopefully for a profit, hopefully make some cash flow in the meantime, these kinds of things. So when we look at investment strategies versus tax strategies, for me, it's all about who has your money. And so I don't know if it's all right, because I know you asked me two questions. Somebody actually asked a question in the Q&A box, and I won't go all the way into details here, but this is a perfect example of an investment strategy in my mind versus a tax strategy. The question was, I have an S Corp, we're planning to buy a used car. How can we get the benefit of 179? When you buy a car, and a used car is better, right? Typically, you don't have that immediate drop in value when you drive it off the lot, right? But often it's more of an investment to get a tax strategy. You still own the car, but the value's severely declined, right? So that's an excellent example of the differences between a tax strategy and an investment strategy. So,
And
and then your second question, you wanted me to hit on some of the big tax strategies. Do you want me to just
Mhm.
deep dive and just start going into tax,
Yeah, start
any
going
specific
because
area?
yeah, because I think we are all, a lot of people are in the real estate and they leverage real estate for the tax benefits. So why don't we start with the real estate? You mentioned that like 1,800 tax strategies. And obviously we cannot run all of them in 1 hour or 60
I'd
minutes,
be impressed. I'd be super
because
impressed, guys.
so, but we should, just take the main ones. Let's start with the real estate first. Then we can talk about the oil and gas. And also you talk about the tribal credit. So I wanted to hear about that too a little bit, that's like
Ooh.
something new.
Ooh, all the good things.
I
So
know,
yeah,
let's start
so
with real estate. Mhm.
let's start with real estate. I love it. So I always call them the five. Okay, there's five main ones and levels in real estate. Okay,
Mhm.
now most of you know the three basic levels. Okay, passive, active, and real estate professional. Okay, so just a minor recap for everyone in the room. Passive is somebody like me. I am a full-time tax strategist. I used to have real estate many, many, many years ago. Thank goodness I sold it before the 2008 bubble, pulled out all my cash before it crashed. Thank goodness, right? So I am passive. I don't deal with the plumber. I have a property management company. It is for me turnkey, right? The renters show up, they leave, all the things. So I'm passive. Active is somebody who does something on the property, typically about 100 hours a year on the property. So maybe you are collecting the rent or you are calling the plumber, something along those lines. And then, of course, you have real estate professional. Now, real estate professional is the gold standard of anything related to real estate. And it is the most desired section in the tax code, and especially works really, really well if you have one partner that makes a bunch of money at something else. So a big high paying W-2, they have a really successful business, whatever it is. The real estate professional is often the other spouse, and they get to combine those two things to make the best possible outcome. And in my personal opinion, if you can get that match, real estate professional plus higher earning income basically means you will never pay another penny of tax ever again. Okay. Now, I cover those three basics because for many people who have 2, 3, 4 properties, they have a full-time job, so they're not going to qualify as real estate professional. They're kind of stuck in this active category. And depending on how much income you make on the other side, if your income's over 150,000, you get no benefit immediately of having real estate. And a lot of people get so excited about investing in real estate, buying real estate. I'm going to be a real estate millionaire, whatever it is. But they never talked to their tax strategist before they bought the real estate. So they were expecting all these write-offs and they get nothing. So on top of the three basics, I always like to bring up two additional ones that are kind of hidden. Okay. One of them is the short-term rental property market. And I believe this is a part of the reason why you've seen such a huge boom over the last 7 years in Airbnb, VRBO, okay? As long as you provide significant services, we're going to come back to that definition, significant services, even if you are single, you have a high-paying W-2 job, but you have that Airbnb short-term rental, and you are providing significant services with an average rental days of 7 days or less, that significant services actually converts that rental property into a small business. Now, that could be good and bad, okay? Normally, for the first 7 years of having that small business, of being this active concierge services type thing, you can do cost segregation, okay, which gives you effectively between 50 and 70% of the purchase price of your house as a deduction in the first year. Okay, which is pretty cool. So if you're buying $1 million property, you're putting it on Airbnb, and you do a cost segregation, it's giving you $500,000 write-off in the first year. Those are huge numbers. That'll wipe out your W-2 for many people. Okay, so awesome front there. Now, significant services is always the big question here. There's a lot of court cases around what is significant services. The easiest way in my mind to describe it is think about it like an Airbnb. Okay. So when you go to an Airbnb, they're cooking you breakfast, they're maybe picking you up from the hotel, they're helping you get tickets, airline tickets, whatever it is, baseball tickets, they're really providing all these extra concierge type services. That is what the IRS is looking for to make this a business rather than a rental property. Okay. So that's an option. That's number 4, right? Number 5 is the aggregation election. And for any of you that actually have a business, an operating business, plus a piece of real estate, if you put your operating business into the piece of real estate that you're using, you can use the aggregation election. Doesn't matter how many hours you spend. Well, you have to spend at least 100 hours. You have to be active, okay? But it doesn't matter what the purchase price of the building is, doesn't matter if it's commercial, doesn't matter if it's a residential, none of that matters. With the aggregation election, you can also use cost segregation to take the cost seg and use it to offset any of your active income in your business. Now, the trick here with an aggregation election, and we have had many, many, many people over the years in webinars going, oh my God, like, can I do that now? I've had my building for 3 years. It has to be made on the very first year that you buy the building, that your business goes into the building, okay? So if you did not make that aggregation election on the first year's tax return, that opportunity is passed.
So I was going to ask you a question regarding the aggregation election. That's a little bit new concept for me. I think I heard about it, but I do not know much in depth. So when you say in the first year, when you bought the real estate, you bring the business there. So like any kind of business or like any kind of real estate could be mixed.
Any kind of business, any kind of real estate. Basically what you're looking at is, so, well, commercial is the most common use for this, right? So you have a bakery and you open, instead of renting, you buy your building, you're putting your bakery, your active business into that building. And so now you are running both the building and your business. You can do an aggregation election for that, okay? For those of us that are in real estate and all we do is real estate, you might want to consider setting up almost in a way like a family office. And the family office business, the active business of running and managing all the real estate, needs an office building. So does it buy a condo? I've seen people use like house level condominiums as offices. That would be an aggregation. Do you buy an office condo? That would be an aggregation, right? So it's some sort of active business that is basically renting, leasing, using the space of a building that you own. Mortgage is okay, but building that you own versus something you rent.
So can you do that? Like I work from home and I have a home office. So can I write that off? This is like everybody asked this question, so I'm going to ask you.
Big question. I love it. Okay. Not under the aggregation election because you live there, right? So the IRS gets really touchy about, so this is your personal, you're using it personally, your kids are there, your spouse is there, your dogs are there, right? Like, no, right? So that will not work for the aggregation election. But Taking home office, absolutely. Okay. Now, this is one of the biggest questions that we get. Many people are almost afraid of taking the home office because they have this weird memory from way back before 1986 that, well, if you took a home office, the IRS was going to audit you. Okay. I said this long before COVID, all right, West Coast, everybody was already remote. Right? For the past 10, 15 years, everybody was remote. Everybody had a home office. Okay. So West Coast, it was never a deal. East Coast, it was a little stranger to have a home office because in the East Coast, everybody went to an office. Post-COVID, the IRS completely dropped any concerns about having a home office or not, or whatever, as long as you're being reasonable. And I think that's one of the biggest things when we start talking about any deduction, any write-off, any investment strategy, any tax strategy. There are three key words that you must apply to everything, okay? Ordinary, necessary, and reasonable, okay? Those three. Now, what we see, where we've seen case law, right, court cases come in, is somebody says, okay, I have a 2,000 square foot house, okay? 60% of it is office. And I'm going to write off 60% of a 2,000. Really? But you're married, you have kids, they have a playroom, you have an exercise, a workout room, you have a TV room that your mother-in-law comes and sits on the couch. How is it possible that 60% of your square footage is business related? Okay. Now, I have seen it happen. Okay, maybe your entire garage is filled with all of your bakery goods, okay, and you're baking. Maybe you built a second kitchen, and so you have the second kitchen for your bakery, whatever it is. So I have seen it happen, but anything over about 10, 12%, the IRS starts to, it's kind of a flag, right? Not an automatic flag, but like they start to look at it. So be careful as to what percentage of home office you're using. So normally what you'd be looking at is the total square footage of the house, the total square footage of your office, and any square feet that are only used for business purposes. So for example, some people will keep filing cabinets of documents in their garage. And so it's, 6 feet long by 3 feet deep, add 18 square feet because you can't park a car on top of the filing cabinets, right? Like it's for business. So when you look at those percentages, once you have that percentage, if it's 7%, 10%, 12%, whatever it is, that percentage applies to every penny that you spend in the home. So did you put in new landscaping this year? Did you put in a new pool? What about pest control? What about your security animals? Okay, you guys can't see it, but I have tons of doggy toys at my feet. I have 5 dogs, okay, and they qualify for security as a write-off because I invite clients, vendors to my home. And I have client information on my location, right? And I definitely need to protect all of my client files. So my 3 big ones are 2 German Shepherds and a Cane Corso. Between them, they're about 350 pounds worth of dog. So nobody is breaking into this house to get anywhere near client files, right? So we come back to ordinary, necessary, and reasonable, right? Is it ordinary and necessary that you have a home office in your home so that you can more efficiently do work? Yeah. Are you being reasonable, right? You're not taking 60% of the square feet, you're taking 7% of the square feet. Yep, ordinary, necessary, okay, and reasonable, right? Necessary, I have to have a place to work and I'm not gonna go rent an office, it's more expensive to rent an office. So those 3 words, ordinary, necessary, and reasonable, will apply to every deduction that you're looking for. Now, we got a question here. Even if you use your home office for deduction, don't you have to pay the rent as an income to personal tax? There are 2 different ways to do the home office, okay? Now, very, very, very much this depends on what other strategies, when we talk about the 1800 strategies, what other strategies are you applying to your primary residence, okay? If you have, DJ, I'll just pick on you because you said I have an S Corp, okay? So if you have an S corporation, one of the deductions you should be using, and if you don't have this, if you've never heard this term, bring it up with your CPA right away. It's something called an accountable plan, okay? Accountable plans allow the S corporation to pay for the percentage of home office, the percentage of personal car use, the percentage of cell phone use, right? Anything that's a personal thing that your business is using, The accountable plan allows for that deduction through the business. So you don't need to pay rent because the business is already taking it off, right? There is no rent to pay you to then pick up the income. So if you have an S Corp, a partnership, a C Corp, you're using an accountable plan, okay? Now, if you're a Schedule C sole proprietorship, right, where your business is being reported inside your personal return, there's actually a special form to report your home office on, as the example here. That's Form 8829. You also do not want to pay yourself rent for that space because otherwise you'd be creating a little circle, right? So you'd be basically double taxing, and we don't want to do that for sure. There's one other strategy. Poor Vinki. Go ahead. Push.
Oh my God, I love it. The way you're going 1,000 miles per hour. This is like awesome. But I wanted to stop you for a second here. I wanted
Yes,
to ask
please.
you about the accountable plan. You mentioned something really
Yes.
good. So, do you have to have a S Corp to use the accountable plan? Because still you can just write off all the business expenses, right? Without the S Corp. So we'll go into
100%.
S Corp, C Corp too a little bit later, but if you can
Yeah.
answer that for now.
Yeah, I think the way to think about it is the accountable plan, you must have the accountable plan to write them off if you are an S Corp, partnership, C Corp. Okay. Because if you don't have the accountable plan, you cannot take any of those expenses. And if the IRS catches you, so this is one of the most common things we hear, right? We're talking about the accountable plan, and somebody says, well, I've had an S Corp for 10 years. I've been writing off my home office. My CPA has never in their entire lives mentioned accountable plan. Fingers crossed for you, the IRS never sees that, okay? Because if the IRS comes in, they will ask you, give us a copy of your accountable plan. And if you don't have it, all of those deductions, they have the right, legal right per the code to yank all of those deductions and make you pay tax on all of them. So an accountable plan, if you have an S Corp, C Corp partnership, you absolutely, it's a one-page piece of paper, guys. Get the accountable plan, stick it in your files, then you're good, right? You have to follow, there's rules you have to follow and things you have to do, but like do the rules, do the follow, do what you need to do, okay? Schedule C is the only entity, a sole prop is the only entity that does not require an accountable plan. But for all of our clients, we make everybody do it because we'd rather have it on file, it's ready. You don't have to think about it again in the future. Here's the formula, here's the pattern. So we're a big fan, Tax Goddess in general as a CPA firm, we're a big fan of set people up for success from the beginning because most people will start as a Schedule C, maybe an LLC taxed as a sole proprietorship or just no entity at all, but starting as a sole proprietorship. I would much, much, much rather that you have everything you need so that in 3 years, when you're making the big bucks and we need to move you to an S Corp or move you to a C Corp or something like that, everything's already there. It's already all in order. You don't need to worry about it. So.
Okay, so there was a question actually, is it a good idea to put rental properties under LLC in the Q&A from, I think from Sanjeev. So can you address that too?
100%. So now let me back up. I'm going to say this right here now. I am not an attorney. Okay. Not an attorney, not an attorney. So the answer I'm giving you is from a taxation perspective, not a legal perspective. Okay. So just big asterisks on that. Okay. From a taxation perspective, the only time it makes sense to me to put, normally you'd put one rental property per LLC, right? So that you're splitting any kind of risk. So if you have 30 rental properties, you have 30 LLCs, okay? You can do something called equity stripping, which will help reduce risk. But again, legal matter, talk to the attorney, okay? The only time from a tax perspective that it makes sense to me to put a rental property into an LLC, especially by itself, is if you're going to also have a master LLC that is collecting all of the rent and paying all of the bills, okay? Having separate LLCs then allows for better allocation of accounting, better allocation of payments, of cash flow. It also allows for a tracking of equity. So a lot of these things are more accounting concepts than they really are tax strategies. We do get a lot of questions, especially in real estate, about using trusts for real estate. So land trusts, the combination of LLCs and land trusts. We have specialty attorneys that deal with that. Okay, so if anybody's going that path, let us know. But from a purely tax perspective, does putting a rental property in an LLC give you any additional tax benefits? If it's one rental, does it give you any additional tax benefits? Some of the strategies, maybe. Are we going to pay the kids? Are we going to try to write off the home office, right? It is helpful for those things. So I can see it both ways.
Perfect. Thank you for answering that. So the next question I'm going to ask you before we go to the Q&A is you were talking about the cost segregation early on, right? So let's touch on that since we're talking about real estate only. So let's talk about the cost segregation, how it benefits the active investors as well as the passive investors. Because I think a lot of people, I have seen that they advertise their deal or opportunity saying that you'll save 60% in taxes, you pay 90% in taxes. The poor passive investors, they don't understand that and they invest and later on they think, oops, I didn't get what I've been told.
Where's my money?
So it's just like
Yeah.
confusion right there. So I would like you to clear that confusion and then tell us about, if there's any special asset classes within real estate that do that for the passive investor, or it's like across the board the same thing?
Absolutely. Okay. So back up here a little bit, passive, active, and real estate professional. Okay. If you qualify as real estate professional, cost seg is your best friend, right? That's why I said real estate plus a W-2, best friend, you'll never pay tax ever again. Like fantastic, do it all day. Okay. But very few people qualify as a real estate professional. The IRS watches this status like a hawk, right? So especially if you've never been a real estate professional before and all of a sudden magically now you're a real estate professional this year, be prepared, right? Be prepared to stand up to the IRS and to prove why you are a real estate professional. Okay, so I'm going to leave that one off the plate because if you qualify, you get cost seg. There's no questions. There's no problems. Okay, let me jump to passive because active is this weird middle ground. Passive. Now, passive. How do I want to say it? Passive is passive. Okay. If you have passive income, if you have passive expenses, those things get trapped in a bucket. So you can only take passive cost segregation, right? If you are passive and the rental's passive, it's passive cost segregation, okay? So if it's passive, it's passive. If you have a passive property that you're going to take a cost seg on, and you have a passive property that maybe you've had for 30 years and there's no more depreciation left, and so you're making positive income on it, passive can offset passive, which is great, okay? W-2 income is active. Interest income is active. Dividend income is active. Basically, everything other than passive real estate will offset passive real estate. You might be able to offset some passive investments. Like earlier, we mentioned oil and gas. With oil and gas, when you first invest, you can choose if you want active or passive. So you could buy a rental property, do the cost seg, be passive, earn money from a good oil and gas investment, okay, earn passive income. Passive K1 would offset passive rental property. So passive is passive. And that's where so many people get kind of sucked in by these, I'm going to call them promoters, right? Oh, we're going to get your tax bill down to zero. Not if they don't know your situation. If they don't know you're passive, you're not, I mean, it's not happening, right? Because you still have your W-2, these active active income items. So passive, real estate professional is real estate professional. Active is this weird middle ground, okay? So as I mentioned, if your income goes over $150,000, right? There's a $25,000, I'm going to call it allowance for active people, okay? So active means typically you're spending more than 100 hours a year. You're not at the real estate professional status, okay? So active, let's say you've got your W-2, okay, but your W-2 is a part-time job. You're making $50,000 a year, it's a part-time job, you're semi-retired, okay, and you go get this piece of real estate, okay? So $50,000 W-2, you have an active income, right, active real estate. If you do a cost seg here and your only other income is this $50,000 W-2, your total is below 150. You can take that cost seg that you do on this rental property and offset your W-2 by a maximum of $25,000. So it's helpful, but it's certainly not going to get your taxes down by 90%, right? I mean, unless your income's this big on the active side. So you really, I think this is one of the biggest pieces that gets missed when people get, just general public get kind of sucked in by promoters. It all sounds great. But if the person you're working with doesn't spend at least minimum 1 hour getting to know who you are, what you do, your income streams. If they don't want to see your tax returns to help you make decisions about whether that investment is good or that investment or that tax strategy, they're in it for them. They're not in it for you. So sorry, sorry, it's my little mini rant. Okay. Like work with people that actually look at your files because they don't know. So
Yeah, no, you said it very well. I think I really like that, the way you explained it. It's really good. So sometimes the question comes up when you do the cost segregation, there is something called recapture at the end. So let's cover that too.
100%. Okay. So you've been a real estate professional all your life. You're in love. Okay. And actually, I'm going to answer this question really quickly because it's perfect timing for it. Mayura, does getting a real estate broker's license provide a more believable IRS real estate professional status? The IRS has very specific laws about the real estate professional status. Okay. There's really two of them. The first one is, do you spend more than 750 hours on real estate? Now, we tell our clients to spend at least 1,000 hours on real estate because the IRS may come in and say, we don't agree to that hour, we don't agree to that hour. And if you only got 750 and they push you down to 748, done. Status is gone. Okay. So we tell our clients to get to 1,000. So that's piece number one. The other rule is you have to spend more time on real estate than you do on anything else.
Mhm.
So if you have a full-time job working 40 hours a week, getting your broker's license isn't going to help you. You'd have to work 41 hours a week on real estate to be qualified as a real estate professional. Okay. So thank you, Mayura. Great, 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 great question. This is very specific. We get this all the time. Does the license help? It helps, but you got to meet the two qualifications. So ignore it is basically the way I was told clients. So come back to the question. Let's say you're a real estate professional or active or passive or whatever, right? You've done all this cost seg, you haven't paid taxes in years, okay? Now you're coming to the point, you are 65, you've decided you're gonna retire, you want everything in liquid cash, okay? You're gonna move into some more stable, long-term kind of, paying dividends kind of investments, whatever it is, okay? You're ready to get out. Now, if you've had these properties and you've done cost segregation, really what cost segregation is in the baseline terms is when you buy a rental property, let's say it's a residential rental property, the normal depreciation is 27.5 years. Okay? What cost seg does is it takes all that depreciation and it smushes it all to the front. So you're getting these huge amounts in year 1 through 5, 5 through 7, it kind of goes down a little bit, 7 to 15, it goes down a little bit. And then after 15, it's like tiny, right? For the rest of the time you've had this property. So if you've had this property for more than 7-10 years and you've done cost seg, most of your expenses have already been taken, right? Most of your depreciation has already been taken up front. If you sell that property, flat out sell it, right? I'm going to sell it to some guy named Bob. Bob's going to buy it. You will pay tax on the depreciation recapture because you got the expense. The IRS wants it back. Okay, so they're really like loaning you the money over this period of time. And if anybody can guess why, the government wants people to buy property. They like incenting people to do what they want to do. They want people to buy property. They want investors, they want businesses to buy property. So they give us these special bonuses like cost segregation, depreciation, to get us to incent us to do more investment.
But I do have a question here that I wanted to ask you. You said when they recapture it at the end, exit. But the thing is, since a bonus depreciation, we accelerated the depreciation, right? So this is the life of the components or the fixtures that we got the cost segregation on or the depreciation on, right? So that life has maybe already done for that particular thing, right? So that should be excluded from the recapture or no?
Oh, don't we wish? Nope. No. Let's put it this way. I've always looked at it as when the government gives you a good, they also give you a bad. The universe has to balance, okay? The IRS is all about balance here, right? When you go, and so this becomes the question of how do you properly exit real estate, right? Which is a very different question here. So if you flat out sell it, you will have depreciation recapture. You will pay 25% on the depreciation recapture, period. So if you took $300,000 of depreciation, you will pay 25% depreciation recapture. Now, there's a piece here to note, right? 25% is higher than the current capital gains tax rate, which is 25%, or sorry, 20%, but it is a lot lower than your ordinary tax rate. Okay, so if you were in the 37% tax rate when you took the depreciation, you got a 37% real estate professional, you got a 37% deduction. Okay, but you only have to repay it at 25%. So again, that real estate professional status is the gold standard, because that means no matter what, at least under the current law, you're getting a 12%, whatever the spread is between your normal tax rate, right, ordinary tax rate, and your depreciation recapture, you're getting a 12% spread that you never have to pay back to anyone ever. So there's huge benefits to being the real estate professional.
Hmm.
Now, there are multiple ways to get out of depreciation recapture. Okay. The most common one is a 1031 exchange. So, yep, I'll cover it lightly here because there's other options, and Todd
There's
here
a
brought it up.
question too. Yeah.
Yep, the installment sale. So we're gonna hit on that for you, Todd. There are other options that may be better for you than a 1031. So let's go back to our example. Okay. I've had these properties a really long time. I'm ready to get out of real estate. I love real estate. It did me well, but I want to move to stocks and bonds and get some dividends. Like I'm done managing the 2 a.m. telephone call if somebody's plumbing is broken. I just don't want to do it. Okay. If you don't want to be in real estate, a 1031 doesn't help you, right? Because a 1031 goes from property to property. That's it. Okay. The benefits of a 1031, there is no depreciation recapture. So for those of you that are selling and you're still going to be in real estate, fine. However, a 1031 does not increase your basis. So the property you 1031 into, you cannot do depreciation again, right? You'll only get it, the original dollars that were already depreciated are gone. You'll only get it on any increase in price that you did, right? New depreciable dollars from that standpoint. So other options to consider, okay? If you're nearing the end of your life cycle in real estate, you may want to consider a 721. This allows you to get out of real estate and go into a REIT, right? Real estate investment trusts or some other real estate partnerships. There's some rules around this, okay? But this allows you to not pay tax on the depreciation recapture, but still be in real estate. So if you like it as an asset class, 721 might be the way to go, okay? Another option that Todd brought up here is an installment sale, okay? Now, Todd, you didn't necessarily with a promissory note to an irrevocable trust with an independent trustee. So Todd here is talking about what's called we hear them called deferred sales trust. We hear them called installment sale trust, 853B. I mean, there's all these names for the thing, okay? But effectively what you're doing here is you are selling a big thing. So I'm going to phrase it big thing for a reason. You're selling a big thing. In this example, that's real estate, but you could be selling a business. You could be selling a classic car collection. You could be selling one of the weirdest ones I've ever heard was a 200-pound emerald that somebody pulled out of a mine. Okay. Like any kind of big thing. We're selling a big thing. You can sell that. You give it to the trust in exchange for a promissory note. So Todd, that's what you're talking about. In exchange for a promissory note, the trust then sells the property to whoever the final buyer is. Okay. The trust has the money. Because there's an independent third-party trust in between you and the sale, you do not pay tax on the money all at once. You pay tax when you take money out of the trust. Okay. Now, there's some goods and bads to the installment sale trust. Let me give you an example here. And thank you for saying not a monetized installment sale trust. Yes, the IRS is getting kind of cranky with the monetized installment sales trusts here. But with the installment sale trust, the IST, one of the downsides is the money that's inside the trust. So let's say you sell this property for $2 million. Okay, so $2 million is sitting inside the trust. You, the seller, has an installment agreement with the trust for $2 million. If the trust makes more than $2 million, the trust keeps anything over $2 million. You don't get it. Okay. So these are fine as long as you know what you're getting into. And I like the installment trust. We'll use them with people. I've seen a lot of people get very upset 7, 8, 9, 10 years. They've worked really hard to build the value of what's inside the trust, only to find out that they only get the 2 million. They don't get the $8 million value that's now sitting inside the trust. The trustee owns that trust. So it can be good, it can be bad. There's ways around that. You can create sub entities. There's all sorts of cool things you can do there. I want to cover just a couple other options here. Okay. So we talked about 1031, we talked about 721, we talked about an IST, installment sales trust. Still today, you have the opportunity to do qualified opportunity zone investing. So if you want to stay in that real estate, you've got that as an option. There are also new programs that are coming out. There's one that our team is currently looking at. It's not, I have not yet put the goddess stamp on it of 100% approved, but there are new programs coming out. We've got one we're looking at called a structured ownership program that would allow something similar. You basically you sell the property, you're going to pay the tax. The structured ownership program is a way for you to invest a small amount and get a very large deduction. Okay, so that's an option. We also see for any of you that have property, but also have a life insurance policy. Now, I'm going to raise my hands right here. I do not sell life insurance, okay? But life insurance, if you don't have cash value life insurance, you are missing out on one of the most important tools in your toolbox. Okay, you can see Vinki going, yes, girl, right? Like, and the reason why I bring it up here in a sale, okay, is if you decide I don't want the 1031, I don't want the 7, I don't want any of these options. I want to sell my property and I want my cash and it's mine. And I'm going to do something else with it. Okay, having a cash value life insurance policy that you can borrow from to pay the taxes and you still earn money on the value inside the cash, why would you not do that, right? I mean, if you're going to sell it and just be done with it and you're going to pay the tax and you're not using any other strategies, right? Leveraged IULs, yes, I love them. I mean, we could do a whole presentation just on life insurance and the value and the benefits, getting out of 401k programs, converting to life insurance. I mean, there's so many options. So for this presentation today, I'm just going to say, if you do not have IUL whole life, VUL, like whichever option you think is best for you, where you can leverage it with cash value, you're missing out. You're literally missing an entire asset class. So anyway, my little rant, but
That's true. And then you can invest too when you're in the
of
IUL.
course.
And then you can just borrow the money, invest, and remember, you don't pay taxes on debt because you're investing the debt basically. So there's like a little key thing there.
Yeah, whole second presentation, Vinki. Clearly, we're gonna have to do a whole separate one on insurance.
So there's a 1031 question in there
Yeah, I
too.
was just
So
about to
maybe
say,
we can address that. Yeah.
for sure. Yeah. So when we do a 1031, can I buy a home that I can use as my primary or secondary and avoid no, nope, 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 nope is the answer. So and I wish, Sumit, that would be amazing. Okay. Now there's always a way. There's always a way. Okay. The commentary would be here. If you're going to do a 1031 and you know down the road that you want that property to be your primary, okay, or your secondary or whatever, okay, 1031 it from a rental into a rental. So buy that house, but you must make it a rental. And please excuse my language, you cannot half-ass trying to rent it. Okay, like you actually put it on Airbnb, get a family living in there for a year-long contract, like do something. It's got to be a rental, because if the IRS catches wind that's what you did, right, that you moved into it, and they will see that. A 1031, the paperwork has the addresses everywhere. As soon as your mailing address, that's one of the few things the IRS is really good at, is looking at what your mailing address is versus what properties you own. No, they will catch it. They will tax all of it. And side note, those cases, when people try to do that particular thing, that has often landed up with fraud charges, which means it's a 25% penalty, jail time. I mean, we're big numbers. Okay, so no, the answer is absolutely not, categorically no. So sorry. Next, should I just keep answering, Vinki? Do you want me?
I mean, yeah, you can answer. This is a 401k question. It's a very common question. And a lot of people, they don't even know that they can leverage their 401k. So I would like you to address that as well. Yeah,
absolutely, 100%. So the question is there a way to use my 401k funds to invest in real estate without penalties and taxes? Now, I'm going to give you two paths, okay? One including life insurance. You're missing asset class here, okay? With a 401k directly, the thing that you really have to be very, very cautious of is that generally you cannot borrow debt. Okay. So if your 401k has $1 million in it and you want to buy 2 rental properties with it, great, 500,000 each, right? Or 300 and 700, like whatever, right? Generally, you do not want to use debt inside what they call when you use a 401k, an IRA, and any of the qualified retirement plans, they typically will tack on like a beginning title called a self-directed 401k or a self-directed IRA, or sometimes you'll hear it called a checkbook LLC that's owned by a 401k or an IRA or whatever it is. Okay. This is very detailed rules, but my warning, my gloss over kind of warning here is don't do it with debt. Okay. Like don't get a mortgage on the property that your 401k now has to pay. There's something called unrelated business income tax that you will get hit with, UBTI, if you do that. Okay. So you talked about no penalties and interest. Don't do it with debt if you don't want penalties and interest. Now there's another way to do it. Okay. Which uses the life insurance. Okay. And this is particularly valuable if you've had the life insurance policy for at least 1 year. Okay, so a year and a day. You really kind of need to, with these life insurance policies, you really need to kind of season them, if that makes any sense. You know, you put your money in, it needs to be there for about a year and a day. You can convert your 401k into life insurance, right? You can literally wipe out the 401k. You will pay, if you're under the 65 years of age or whatever, you will pay the 10% penalty if you do that. But once it's in the life insurance policy can, of course, pay the tax bill, because on conversion, you're going to have a tax bill. It can pay the tax bill, but it also now gives you access to all of that money to do whatever you want, wherever you want, get mortgages, do whatever you want to with. Okay. So which path you want to go? Often people will, if they have a big enough 401k, $1 million, 2 million, 2.5, like wherever that is, basically north of $1 million. Often they'll split it and they'll say, great, I'm going to do one house for 500,000 inside the IRA, and the other amount, the other 500k, I'm going to roll into life insurance and do the other house. And it's almost more of like a double breeding ground here, because any funds, any value that's in that 401k at some point down the road will be taxable, right? And so I've seen people, if you have a Roth, go for it all day, love it, right? Grow the value, grow the value, grow the value. Not many people have large Roth accounts unless they've done a previous conversion of a traditional 401k or traditional defined benefit plan into a Roth type account. So yes, it can be done. There's a lot of specialty rules. Talk to your advisors.
Yeah, that's true. Talk to your advisors. That's the best question. But the thing is, I do have a question here for you.
Yeah.
A lot of people, I mean, I do too. I have a EQRP for my 401k. You just roll over your 401k into a qualified retirement plan. From there, you can invest. And you talk about the UBIT. UBIT is good, but at the same time, because UBIT is going to be on the borrowed money, right? The loan that you're getting against your real estate. So that's where the UBIT is going to come in. But then you get the cost aggregation or the depreciation, the losses, right? So can you use those against your UBIT a little bit?
I mean, really, the big picture is it doesn't often help. Okay, sometimes, yes. I tell people to ignore them, because if it's inside inside any kind of qualified anything, okay, you yourself are not going to see any benefits. So why would you cost seg? Why would you? I mean, your expenses. It doesn't generally. All it's doing is reducing it inside the plan. Kind of. Yeah, we don't tend often. We tell people, if you're going to buy real estate inside the plan, just leave it alone, let it do its thing, right? There's not really, in my opinion, any reason to go after cost seg or any of the other pieces. So
interesting. But the thing is, if it's a bigger of a property, like millions of dollars or whatever, and the loan is that big, it might be beneficial to look at it at that time.
Could be. Yeah, and I think this is really where it is, right? Is no matter what you do, I mean, Vinki, you posted the disclaimer right off the bat. Do not take this as tax advice. Okay, guys, if you're not working with an advisor who knows what they're talking about and who is actually running calculations on your custom situation, you can't answer those kinds of questions. Maybe it does help the UBIT. You got to look at it, and you got to look at the details. You're right. If you've got 50 apartment buildings of 100 apartments each, probably going to help, right? But you don't know that until you get in there and run the numbers. So
that's true. So there's another question. It's an anonymous person. It says, can I keep the primary home as it's and buy a new home as primary home to keep the interest rate on the first home, in IRS perspective, I still consider first home as a residential, and can I keep second home as primary?
So I think I'm going to try to rephrase the question, and whoever anonymous is, if I'm getting your question wrong, please give us a new question here. The interest rate you have in your home is done by your mortgage company, okay? And the IRS and your mortgage company don't talk to each other unless you've done something really, 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 really bad, okay? And they're trying to nail you to the wall. They don't talk to each other. So if you're talking about keeping the interest rate on the first home, it's really up to your mortgage company as to whether they find out you've converted it to a rental or not. Okay. Now, most people are not calling the mortgage company saying, hey, I'm converting this one to a rental, because then the mortgage company will change the rate. Okay. From the IRS's perspective, whatever you want to do is just fine, right? If you had your first home, you've got a mortgage on it, you make that a rental and you move into a new primary home, you're fine. Totally good. No problems from the IRS's perspective. As long as you report all your income, the IRS doesn't care. So yeah, great
Perfect.
question.
I know. I mean, oh my God, Shauna, you're just like a powerhouse of knowledge. That's what I have to say. This session is so good. We are already almost at the top of the hour, but I'm going to
Ooh,
ask a couple more questions
yeah,
before I
we
let you
went
go.
fast.
I might run into have you back. We might want to have another workshop. We have tons more questions. So, have you seen any changes in the recent years from the law perspective and the tax perspective? Any changes that the investors should know about?
Yeah, I think the biggest thing, one of the ones that immediately comes to mind, especially when we start talking about investing, not specifically real estate, but the IRS put out, this was probably 6 months ago now, the IRS put out caps on return on investment. Okay.
Mhm.
They started with syndicated conservation easements. And a lot of real estate folks tend to go to conservation easements because they understand real estate, they understand the deal. There were many, many, many syndicated conservation easements that were offering 10 times ROI. I saw one at 23 times ROI. Okay. The IRS came in about 6 months ago and said, if it's more than 2.5 times, you will be audited. Will. It could still be valid, could still absolutely be valid. As far as a 23 times ROI, that could be valid. But the IRS flat out, point blank, anything more than 2.5 times. So I caution all of our real estate investors out there, like, please, if you're seeing any deal where something is saying it's more than 2.5 times, make sure you're doing your due diligence. You're working with somebody that knows their stuff. They've got audit protection on you on that investment, on whatever it is. So I think that's the biggest thing that's really come out recently. So.
Right. Okay. So another question that I'm going to ask you is, how might tax strategies evolve in the coming years, the next 5 to 10 years? Because there's a lot of things are happening. This crowdfunding, syndication, you already talked about that a little
Yeah.
bit. People are coming, creative ways
Of
to,
course, create
start
deals.
out or create this capital stack and all that. If you
Yeah.
can talk about that.
Yeah, well, and I feel a little bit bad because we'll find out in what 10 days as to which path this is going to go, at least for the next 4 years, as to who's our new president. So yeah, I mean, I think maybe the way to think about this big picture is that, again, the IRS incents people to do what they want them to do. Okay. People will always come up with creative ways. Well, the law said this, so I'm going to try this and try that and try this. Generally, I'm not a big fan of doing things the first year they come out, because I want to see, what do the court cases say? How does the IRS react to whatever it is? Okay. And on a scale of aggression, 0 to 10, 10 meaning we're all going to jail, I'm an 8, right? I'm pretty aggressive, okay? But there are certain things that, let's just wait a year. Let's just see how things go. So I think the biggest thing with the IRS, with court cases, they always go back to whatever the transaction is, ordinary, necessary, and reasonable. Why is a 23 times ROI on syndicated conservation ordinary, necessary? Why? Right? They always come back to those three. So if you're looking at something, if you're looking at investment and something, you're like, it's too good to be true. But ordinary, necessary, reasonable. Explain it to me, promoter. Explain to me how this thing is ordinary, necessary, reasonable. And I think that's one of the big pieces is when you're using tax strategy. I mentioned we use over 1,800 strategies. It is very rare. It happens, but it's super rare that one strategy is going to save you 500,000 in taxes. Okay. More often than not, it's this one saves 50,000. This one saves 80,000. This one saves 23,000. The numbers go all over. And so for an average tax strategy plan, you know, we call our strategic tax coaching, right? Because it's really coaching you, telling you what to do, how to do it. For our plans, an average person's going to end up with between 20 and 25 strategies, which combined will get you down to, it's actually pretty cool. Our average tax rate for our clients is 6%, 6.92%. So, but you have to combine them, right? This is not just a one silver bullet does all the things, unless you're a real estate professional. You guys have your thing, cost egg, it's amazing, and there you go. So. Yeah.
Wow. So there's one more question before we call it a day. I have come across trust deed lien position providing interest at 18% for fixed term on promissory note. And is it allowed in real estate as they use funds for real estate development?
And I'm so sorry, I'm not quite sure I understand the question. Is it allowed? You are allowed to do anything that is not illegal, right? So not drugs, trafficking, like that kind of thing. So yes, if they're offering you an 18% fixed on a promissory note and you've got the proper documents, your attorneys have looked at it, that kind of thing, and the documents are all straight and square, that's fine. My gut says you're trying to ask whether or not this would like help you with the hours towards being a real estate professional, maybe. You know, you got to hit that 750 hours across any kind of real estate. So it could be construction people almost automatically. If you own a construction firm, you're almost automatically a real estate professional. Okay. So yeah, definitely be taking a look at the rules for real estate professional. I'm so sorry if I misunderstood the question there. So.
Okay, no, that's fine. I think we are at the top of the hour. I'm gonna have you back, Shauna. Actually, he put the follow-up in there. He said, in
legality is SEC may have
legality.
limitation. Right, and so this is where you talk to your lawyer right here, right? Like, what limitations am I going to get in trouble? 100%. Yeah. So yeah, just report the interest. If you're making 18%, just make sure you report it. The IRS will be happy with you. So.
Great. Thanks, Shauna. Oh my God, this was such a power pack session. And then Shauna is very generous. She's going to give us the free consultation. I put the link in the chat. So if you wanted to talk to her further, please go ahead and schedule your call. She's giving a free consultation to all my network. Thank you, Shauna, for doing that. And I'm definitely wanted to have you back because I think I have tons more questions and so does the audience. And it's just like a kind of scratch on the surface, I would say, you know. So let me put the link again in the chat before you guys go. Grab that link, schedule your call with Shauna, and then we'll see you in our next session. We'll do a maybe longer workshop next time. Right, Shauna?
I love it. I'm in. I'll try and keep up the energy for as long as we can.
That's true. I love your energy, Shauna. You're just like a powerhouse.
Aww.
Thank you, everybody. Thanks for joining today. We'll be back with another awesome guest next month, and I will look forward to seeing you there. Bye, everyone.
Bye.